I want you to pay extremely close attention to what I'm about to explain, because most people are not mentally prepared for this discussion. XRP is positioning itself for a situation where available supply doesn't merely tighten, it effectively vanishes. Not over long decades, not at a slow crawl, but quickly enough that many people will wake up one day and realize they completely misunderstood what was unfolding right in front of them. Before you dismiss this and think, here we go again, another XRP hype narrative, slow down. That is not what this is. This is not random price guessing. This is not hopium. This is about mechanics, about how liquidity actually behaves, how institutions operate, and why the environment forming around 2026 is likely to look very different from anything most retail participants are accustomed to. When I say XRP could begin disappearing overnight, I'm not referring to a magic burn event or a single headline that sends price vertical in one candle. I'm talking about supply shock dynamics, the dull, unattractive kind that only becomes obvious after the opportunity is already gone. The type where by the time social media figures it out, the positioning window has already closed. Here's the reality most people don't want to accept. Many assume supply shocks start with price moves and fundamentals follow later. In real markets, it's the opposite. True supply shocks begin quietly, through custody changes, balance sheet decisions, and institutions locking assets away off exchanges where retail never sees them. Then one day liquidity dries up, not because demand suddenly exploded, but because available supply had already been removed from circulation, and 2026 is shaping up to be the point where several of these forces converge at once. In this discussion, I'm going to outline exactly what those forces are, why this has nothing to do with retail hype, why memes and influencer noise are irrelevant, and why the most important signals aren't coming from XRP personalities. They're coming from people who spent years ridiculing crypto and are now integrating it quietly into their systems. I'll also explain how I personally think about positioning in this environment, not through all-in bets or emotional exits, but through timing, patience, and respect for cycles. Because ignoring cycles is how the market humbles people repeatedly. Let's address something immediately and without sugarcoating it. We are not experiencing a supply shock today. Anyone claiming XRP is already in a supply shock either doesn't understand liquidity or is intentionally misleading you. Current global conditions don't support it. Liquidity remains constrained. Interest rates are restrictive. Risk appetite is subdued. Supply shocks don't emerge in those conditions. They occur after pain, when policy pivots, when liquidity returns, when rates roll over, when capital suddenly needs deployment, and institutions move into assets with existing infrastructure, compliance, and reach. This is where many people get blindsided, because while retail focuses on short-term charts and debates XRP's relevance, the largest financial institutions are making long-term structural decisions. They are not speculating, they are building systems, and once those systems are operational, they don't care what price you paid or whether you believed early enough. One of the clearest signals of this shift came from a former crypto critic, Jamie Dimon of JP Morgan. For years, he dismissed crypto as worthless and fraudulent, and now he openly acknowledges blockchain, stablecoins, smart contracts, and digital settlement as unavoidable components of finance. That shift isn't casual commentary, it's capitulation. And when figures like that change tone, it's because economics forced the issue. Now slow this down, because most people miss why that shift matters. When leaders of banks this size publicly accept blockchain, the signal isn't mainstream adoption, it's strategic preparation. Dimon didn't just acknowledge crypto. He spoke about stablecoins, programmable contracts, and efficient value transfer. That reveals the direction institutions are heading. Banks are no longer asking whether blockchain will be used, they're deciding how much of the infrastructure they can control themselves. JP Morgan will push its own tokens, Bank of America will build its own rails. European banks will develop regulator-aligned systems, because no institution wants dependency on another bank's proprietary network. But fragmentation destroys efficiency, and if every bank issues its own token, interoperability becomes mandatory. You still need a neutral settlement bridge that allows value to move across systems without forcing trust between competitors. And that's where assets like XRP quietly re-enter the conversation, not because XRP replaces banks, not because it dominates everything, but because it doesn't need to. Even a small percentage of settlement flows, tokenized asset transfers, or liquidity bridging in trillion-dollar markets completely changes demand dynamics. 10% of massive markets is not small, it's transformative, and this is where scale gets underestimated. Add to that what Larry Fink and BlackRock are saying about tokenization entering its early internet phase. Capital is cautious. Institutions are testing, piloting, and allocating slowly. That's why adoption looks boring. Boring is the point. Second, institutional rails must be live, not conceptual. Custody, compliance, trust banking, and counterparty risk must be solved. That's what Ripple's recent moves are addressing. Third, capital must be forced to compete for limited supply, which only happens when flows accelerate faster than liquidity sourcing. ETFs, payment corridors, and tokenized settlement alone don't cause shocks, but overlapping during easing cycles, they do. Today we are not there yet. Today is positioning. Today is accumulation. Today is infrastructure, while sentiment remains divided. That's how early stages always look. This is where patience separates winners from exit liquidity. Let's talk realistic outcomes. Extreme scenarios require perfect alignment and aren't guaranteed. Moderate bullish scenarios are far more likely, where easing occurs, institutions allocate incrementally, and XRP captures meaningful settlement share. In that environment, double-digit prices are plausible over a cycle, not overnight. If XRP ever moves parabolic, it won't feel safe or obvious. It never does. That's why this phase feels frustrating. Markets offer probability, not certainty, and probability suggests groundwork is being laid but triggers aren't pulled yet. The correct mindset isn't chasing or panicking, it's preparation. Expect volatility, expect setbacks, expect manipulation in thin liquidity, and position so you're already seated if the move comes. Execution is where most people fail, not belief. They react emotionally, buy into comfort, freeze on drops, and sell when volatility feels personal. That's not conviction, that's hope. Real accumulation happens when price is dull and conviction is uncomfortable. If XRP truly sets up for a future supply squeeze, the market will likely attempt to shake holders out first through fake breakdowns, slow grinds, and sudden spikes. That's how thin liquidity behaves during quiet positioning. A rational approach means ignoring exact targets, thinking in phases, managing risk, and accepting uncertainty. Even if XRP succeeds, most won't benefit because they'll sell too early or abandon the thesis during boredom. Markets reward emotional discipline, not intelligence alone. If liquidity flips in 2026, XRP won't wait for confirmation. It will move when positioning is already done. So the real question isn't whether a supply shock happens, it's whether you can hold without validation. XRP doesn't need hype to succeed. It needs structural relevance, rails, custody, settlement, compliance, boring things that quietly change systems. If that transition accelerates, price will eventually reflect it mechanically. But there are no guarantees. Markets don't reward loyalty. They reward alignment of timing and positioning. Discipline matters more than conviction. Plan entries before euphoria, exits before greed. Size positions responsibly, and accept missing some upside over round-tripping everything. If XRP fails, risk management keeps you intact. If it succeeds, only discipline lets you benefit. Your biggest enemy isn't manipulation or institutions, it's emotional reaction. Breathe, zoom out, follow data, not noise. This is educational, not financial advice. Crypto is volatile and risky. Do your own research, never risk what you can't afford to lose, stay patient, stay objective, and don't confuse conviction with recklessness.